Greetings to all my viewers and thanks for watching. Let's continue reading and learning what we had been doing, and the chapter in hand today is the balance of payments, right? So let's begin. So to understand balance of payments, let's have a discussion in the layman's language, right? What does this statement say and what is its importance? Let's understand. As we record every financial transaction, a female does it for her household, a school does it for the whole school, a company does it for the whole company. Similarly, a nation does it for the whole nation. So when a single penny moves across the borders, comes into the country or goes out of the country, right? So that systematically is recorded somewhere, and those records are called balance of payments, right? So what does it do? Balance of payment is an accounting statement. Why do we say accounting statement? There is a systematic recording of it. It has got debit and credit side, some current and capital accounts. That's why it's an accounting statement that provides a systematic record of all the economic transaction, right, between the residents of the country, the rest of the world in a given period of time. As I always recommend, for giving one marker definition also, if you have not given a one of many components required here, maybe you lose half a mark. So you, whatever is underlined here right across in front of you, that is making all the components of this definition, the accounting statement, a systematic record, all the economic transaction, the relationship between the residents and the rest of the world, and then how long it is made for. It's for 1 year, right? The financial year. So all these weave together to make the definition of balance of payments. Now, when we talk about these, so what are the types of transactions? It would be definitely coming to you. Yes, we do the exports, we do imports, right? So it's not merely imports and exports. There are a number of other things which fall under the category of economic transactions. You're able to see these things, imports and exports, and these fall under the category of visible items. But there are many other things which can't be felt, touched, seen. So those are the invisible items, and the invisible items also do let the exchange of money from one country to another. So that will be dealt in detail. Unilateral transactions, you all know, one-sided transaction. Uni means one, bilateral means two. So in our national income, we have read that unilateral transactions like gifts, remittances, where there is no return of that transaction, right? So gifts and other remittances fall under these one-way transactions, and we call these unilateral transactions. And capital transfers, of course, if somebody is buying, selling, creating any asset or liability. So all these which relate to not to the routine items but to the non-recurring things, means the assets and liability things. So what did we do in this previous discussion? We simply talked about there are a number of things through which the money is exchanged with the one and the other country, and these transactions could be of these natures, right? Visible, invisible, unilateral, capital transfers. So all these things would be dealt in detail. So let's talk about the structure of balance of payment. It works on a double entry system. Just one marker question. It is having two sides, debit side and credit side. The accountancy students very well know that whenever there is some inflow coming to you, so that is credited. And whenever some outflow is there, so that is debited. See, outflows or the uses of foreign exchange are recorded on the debit side, whereas inflows and sources are recorded on the credit side. And because double entry system means, this T table is there, you have one side debit, one side credit, and you would have all the balances written here. So if the balances match with each other, these are balanced. Hence, otherwise it's either in surplus or in deficit. But mind you, it's just a thing to learn. Otherwise, there would never be a possibility, virtually not, where you have balanced BOP, because millions, billions, and trillions of money is mentioned in debit and credit. Is it a weird possibility? No, there would not be any possibility that left hand side matches the right hand side. So you would definitely be having either the surplus of BOP, means you have more of money coming to your country, and the deficit BOP means the money is going out of your country more, right? So let's go ahead. When we talk about balance of trade, I would try to showcase that we said a moment back that BOP is a double entry system wherein we have the debit and the credit side, right? And we have a capital account as well as current account that would be dealt in later. So why did I make this T? Just to make you understand that, say this is current account and this is capital account, right? There are two types of accounts you would get across, and you would have both the accounts having the debit side, credit side, debit side, as well as credit side, right? So BOT, balance of trade, BOT is just one of the transactions of the whole chart. So we are trying to focus now on one major and most important concept of BOP, which is one type of transaction of BOP, the whole chart, right? So let's understand what is balance of trade. So balance of trade means the difference in the value of exports and imports of the goods. And here we say visible items or goods, or you sometimes get to have this merchandise, right? Anything would be written, right? Visible or, these are different words which are used for this balance of trade. So the difference between the amount of exports and imports is the balance of trade. And this is very important and crucial in deciding the balance of trade and the balance of payment. Right. Now, balance of trade can be in surplus, can be in deficit. How and why? If the credit items of the balance of trade means the trading. If our exports are more than imports, it means exports means things are going out, but money is received more, right? And debit means when the money is going and things are coming. But this is the systematic statement of the money, right? So when would we have the credit things? When exports happen, and debit when imports happen. So when our exports are more than imports, then it is a situation of surplus BOT. And if vice versa happens, that becomes a deficit BOP. Deficit is also called that it's unfavorable for the country. Why? Because every country needs the foreign exchange, and if foreign exchange is reduced, that's a negative sign. Why is it important? Because foreign exchange is damn important after, especially after LPG 1991, post globalization, when the whole world has become a village and there is free movement of people, goods, services. So anybody demands the currency of the other nation for any of the work. So every nation must have its own reserve of other nations' currency. That's why it's very important. Now the question is, what is the difference between BOT and BOP? And this table was drawn just to tell you that only this elliptical shape is BOT. See, the whatever is the balance, right, will give you the balance of BOT. But when we do all the transactions of current account, all the transactions of capital account, and whatever is the result, then that's called the result of BOP. So now with this basic understanding, let's have the difference between BOT and BOP. So it is merely talking about exports and imports of visible items only, but it is a systematic record of all the economic transactions which happen in the country with the rest of the world. So only visible items, all items, and all items you can name a few items like visible, invisible, unilateral transactions, capital transfers, right? So here you must note that whenever we are talking about BOT, we are not at all concerned with assets and liabilities. It's just a matter of current account. So capital nature is not found here. No record happens here. All transactions of capital and current transactions do happen in BOP. Right? It records all the types of transactions, capital as well current. But here it says capital transactions are there. No, it's not there. Yes, it is there. It's a narrower concept. Why? Because out of the huge concept of BOP, it's just one segment is focused in BOT. So it's a narrow and it's a wider concept. Unfavorable BOT can be met out of favorable BOP, but unfavorable BOP cannot be met out of BOT. This is true. If there is some insufficiency because of unfavorable BOT, other transactions can offset it. But if the whole BOP is unfavorable, BOT cannot set it off. Now, the components of balance of payment. So this was just one segment, BOP. Now let's talk about the structure. As I said little before, that whenever we are talking about the balance of payment, it has got two types of accounts. One is the current and other is capital. And yes, by now I hope all of us are very clear with this, that current account means all the transactions related to export and imports of goods, services, and unilateral transactions means there is no mention of assets or liabilities. These two are not there in current account. So what are the components? First is the export and imports of goods. As I told you, we call goods as merchandise as well as visible trade. Right. So whenever the money flows in out of some exports, that is recorded on the credit side. Whenever the money goes out, so that is recorded on the debit side on account of the imports. Then we talk about the services. Services are called invisible ticket. And I tell my students to have the acronym. What is it? SIB, shipping, insurance, banking. These services, when result into the inflow of the money, are recorded on the credit side, else on the debit side. Then we have unilateral or unrequited transfers to and from abroad. It means we are talking about the one-sided transactions, means the unilateral transactions as read in the national income, like gifts, donations, charities, all these personal remittances when are received from some nation, these are on credit side, and when are given to the other nation means to the rest of the world, so that is on the debit side. So receipts on the credit side, right? And to means paid to on the debit side. And income receipt and payments to and abroad, these includes the investment income. Try and understand. This is the most important, I would say, to confuse the students. Students say investment income. Yes. If you are investing on a piece of land, so that is your investment. So that would never be a part of your current account. But when that land is giving you some rental income, so that rental income is your investment income, and that rental income is recorded in the current account, right? So current account shows the net transactions of all these. And when we talk about the balance of trade and current account, now what is this situation? Say we are talking about current account. Current account has got the debit and credit side of many things. One, the visible, the second is invisible, third is one-sided transaction, fourth side is investment incomes. So when we are talking about the difference of one component with whole chart, the whole chart is for current account, right? And only one transaction is of BOT. Now you can see which is a narrow concept. BOT is a narrow concept because it's talking only about one transaction, and current account is a wider concept. BOP includes only the visible items, and current account includes visible, invisible, one-sided, investment income, etc., etc. So this difference is pretty clear. Now, the balance on current account means for every account, you write the debit, the credit, and the balance. So, whatever is the balance of all these four items would be the balance of current account. Right. So this way, if current account shows more of the money coming to your nation, so this would be a situation of CAS, current account surplus. It means the credit items are more than the debit items, and that indicates that net inflow of the foreign exchange is more than the outflow. When I say net inflow, it means inflow minus outflow. Okay, net word is important here. Current account surplus arises when the value of exports of all these is more than the value of imports of all these goods and services. And CAS means surplus. It signifies that nation is a lender to the rest of the world because there is more of money with it, right? And the other thing is the deficit, the current account deficit. It means the money coming to the country is lesser and money going out of the country is more. So CAD signifies that the nation is a borrower from the rest of the world and it would need some money from the other countries. So the components of current account are given in a nutshell here, which we have discussed so far. Visible items, invisible items, unilateral transactions, and income receipts. So we talk about the debit and the credit items. And then we talk about the balance here, and hence we land on this current account balance after taking into consideration all the four types of items with their debit and credit side. So with this, the current account gets over. In the next video, we will talk about the capital account. Stay tuned and I'll cover the video shortly. Bye-bye. See ya.